Imagine this: while Bitcoin plummets below $65,000 amid fresh tariff chaos, gold surges to new heights as investors flock to traditional safe havens. Is this the great rotation we've been warning about? And what does it mean for crypto's recovery? Stick around as we break it down. Welcome to the Generational Wealth Community, your pathway from knowledge to legacy. We don't chase hype, we decode the market. Today, we're diving deep into the gold rotation and crypto liquidity challenges shaking up the markets in February 2026. If you're feeling the pinch from recent volatility, you're not alone. Capital is shifting dramatically from crypto to gold, fueled by tariff shocks, stablecoin contractions, and broader economic uncertainty. Let's unpack this step by step, with fresh data straight from the wires, to help you navigate what could be a pivotal moment for your portfolio. First off, let's talk about the tariff turmoil that's at the heart of this mess. President Donald Trump recently announced plans to raise global tariffs to 15%, a move that came hot on the heels of the Supreme Court's decision to strike down previous tariffs imposed under emergency powers. This isn't just policy jargon, it's creating real waves. The administration is now invoking Section 122 of the Trade Act of 1974 to implement these new duties, injecting fresh uncertainty into global trade. Asian equities might be holding up, but crypto? Not so much. Bitcoin fell as much as 5% to below $65,000 in early trading. Diverging sharply from traditional assets, tariff angst is rattling risk-sensitive markets, with investors worried about slowed global growth and tighter liquidity conditions, both of which are kryptonite for cryptocurrencies. Now, enter the great rotation: capital fleeing crypto and pouring into gold. Spot gold traded over 1% higher, climbing to a 3-week high near $5,150 per ounce on renewed safe haven demand. This isn't a coincidence. As geopolitical tensions rise, think United States, Iran, nuclear talks, and military buildups in the Middle East, gold is shining as the go-to hedge against dollar weakness and trade barriers. Bitcoin, often called digital gold, is behaving more like a high-beta risk asset right now. The Bitcoin-to-gold ratio has sunk to around 14 to 15, with a negative 0.17 correlation over the past year. In plain terms, when tariffs spike uncertainty, investors are treating crypto like tech stocks, volatile and expendable. While gold's tangibility and history as an inflation hedge pull in billions, JP Morgan even notes Bitcoin's volatility relative to gold is at a record low 1.5, suggesting a theoretical $266,000 Bitcoin price on a volatility-adjusted basis. But that's not happening anytime soon amid this shift. Compounding this is the liquidity crunch hitting crypto hard. Stablecoins, the backbone of crypto trading, are flashing distress signals. Tether's USDT is showing contraction patterns reminiscent of the post-FTX meltdown in 2022, indicating rare liquidity strain. This isn't minor, it's a sign of broader market stress. Over the weekend, Bitcoin's sell-off led to about $100 billion in crypto market value losses, triggered by this policy whiplash. Liquidations have been brutal. Derivatives exchanges wiped out around $507 million in contracts in the past 24 hours alone, with 86% hitting long positions as Bitcoin dropped from $67,700 to $64,300. Another $464 million in liquidations followed the initial tariff shock, creating a feedback loop of forced selling and deleveraging. Futures open interest plunged 20% from its peak, draining speculative capital and exacerbating the downturn. So what does this mean for market recovery? Short term, it's looking rocky. Crypto sentiment has plunged to extreme fear levels, with Bitcoin down 25% since early 2026, and the broader markets shedding over $2 trillion from its peak. Analysts are eyeing $60,000 as the critical support level. If it breaks, we could see a slide toward $52,000 to $55,000, triggering more liquidations. The dollar's weakening and potential for higher for longer rates aren't helping, as they weigh on risk assets like crypto. Longer term, though, there's hope. If tariff negotiations lead to reciprocal agreements with partners like Indonesia and India, it could stabilize sentiment and draw capital back by mid-2026. Successful trade deals might boost U.S. growth, supporting a crypto rebound. But right now, the rotation to gold underscores a key lesson. In times of macro uncertainty, diversification beyond crypto is crucial. We've seen this play out before. Crypto winters test resilience, but they also forge stronger foundations. Keep an eye on Federal Reserve responses and dollar index movements. They'll be key to any turnaround. Subscribe for daily recaps, drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.